Investors face much investment uncertainty today, with many facing difficulty in making informed investment decisions. Given the current market volatility, asset managers have the responsibility to advise investors of the best investment strategies to adopt. Earlier, I spoke to Duggan Matthews, investment professional at Marriot Asset Management, to find out more. Doug, thanks for your time. Now, the South African economy is facing many headwinds, and many people are saying the outlook is uncertain. I mean, we saw the government slightly downgrading its growth forecast. In this environment, where are you guys standing in terms of your over-investment strategy? Which assets are likely to perform?
Yeah, I think investors today certainly are faced with a lot of economic and investment uncertainty out there. Not only do investors have to choose between over 1,000 different unit trusts, there's also numerous economic variables which could all have a significant impact on markets in the years ahead. If you just look at America, the fiscal cliff issue has only been partially resolved, and they've got the debt ceiling issue coming up again later this year, which caused so much chaos in markets in 2011. If you look at the Eurozone, that economy is struggling at the moment, and the big challenge that region faces is trying to manage down those debt levels in those regions without triggering a severe recession.
Absolutely, and that all impacts our markets here in South Africa.
Absolutely. We're part of a global economy now. Things that happen in those regions all have a big impact on the South African market. And we just feel at the moment, given the uncertainty in the market, investors will be best served by adopting an investment strategy based on a bottom-up selection of companies that are likely to be resilient to the unexpected events I've been chatting about.
Explain yourself. Bottom-up, what do you mean?
This approach really means looking at the companies that you're investing in, rather than trying to have a broad macro view of what's going on out there. Leave that alone and really concentrate on where you're investing your money from a stock-by-stock level.
Who are performers? Where are the strong managers and that kind of thing? That's what you're asking really investors to do.
You're wanting to invest in good, solid companies that are able to perform consistently regardless of the economic environment which they're operating in. And there are numerous examples, both locally and offshore, of these type of companies who will be largely unaffected by what happens in America in terms of resolving the fiscal cliff, whether the Eurozone breaks up, just because of the solid companies that they are and the nature of their brands and the products they produce.
So you're saying really it's a stock picker's market, but across sectors, would you be able to pick particular themes?
Yeah, I think that you want to invest in companies where consumers have to spend their money today. The times are tough. Consumers, both locally and international, have come under pressure, and you really want to be invested in companies who produce basic necessities with strong brands, because you can be confident that consumers are still going to spend their money there at the end of the month.
Consumer facing. Don't touch the miners, you're saying.
It's a difficult one there. Mining company profits is to a large extent influenced by what happens in the global economy. And as I mentioned right in the beginning of the show, there's just so many different factors that could impact how the global economy performs going forward, that trying to have a reasonable expectation of how a mining company is going to perform over the next 5 years is difficult.
But even the consumer as well is facing many headwinds. I mean, I was reading a number of articles today talking about the fact that the Reserve Bank this year is unlikely to touch those interest rates, but at the same time we do know about the indebtedness of the consumer. We do know also about the high cost of living that's going on, even though the inflation numbers do seem to be saying inflation is going to be stable. So even on that front, you'll be challenged to try and find value within that basket of stocks.
Absolutely. I think the consumer certainly is coming under pressure. Fortunately, we've got very low interest rates in South Africa, which has given some relief to consumers. They're also accessing unsecured credit at the moment, which has helped. And that is why our emphasis with regards to the companies we're choosing to invest in are really companies that produce your basic necessity. The type of companies that produce goods that consumers have to buy, regardless of good times or bad times. Your food producers, telecommunication companies, alcohol producers,
Yeah.
the likes of British American Tobacco, etc. Those type of bottom drawer
We still
companies.
need to talk, we still need to eat, still need to phone our friends and all those kind of things. Let's
Absolutely.
talk broad valuations of the
Yes.
market. Now, you never get any kind of agreement on whether our market is overvalued or not. But you're saying actually, even from that perspective, don't look at the overall index. Go drill deep into the companies. But overall, how do you see the JSE playing out at the moment?
Yeah, I think from a big picture perspective, we don't see much value in the local markets. Equity dividend yields are well below their historic averages.
Yeah.
Property yields are low, bond yields are low. But the situation offshore is completely different.
Right.
Offshore investors are able to invest in quality first world mega cap stocks of the likes of Procter & Gamble,
Right.
Nestle, Johnson & Johnson, Pfizer, all international brands on very attractive valuations, yields in the region of 3.5% to 4%, which is well above their historic averages.
Sure.
And those companies today are in very healthy positions.
So you're talking offshore developed world, you're not talking offshore emerging.
No, offshore developed world. There's a subtlety there because a lot of those companies that I've mentioned have a big presence in emerging markets.
Sure.
So they still stand to benefit from the higher levels of economic growth in emerging markets.
Yeah.
But they are well-governed companies with incredibly powerful brands. Just to give you an example of one company, a favorite of ours is Nestle.
Yeah.
That company owns over 8,000 brands. It sells 1 billion products a day in 132 different countries around the world.
Okay.
29 of those brands generate that company in the region of $1 billion of revenue each year.
Right.
You can look at Procter & Gamble. They've got 25 brands that generate the company in the region of $1 billion of revenue a year. The items that they sell range from household necessities like Pampers, nappies, to toothbrushes and toothpaste, to batteries and shavers.
Yeah.
Just interesting to note that Procter & Gamble's Duracell battery is the largest battery manufacturer in the world, and 25 billion batteries are consumed each year.
Absolutely.
The Procter & Gamble Gillette brand has 70% of the global market share for razors and blades globally.
Right.
These are products we have to spend our money on. Unfortunately, we go through them rapidly and have to be replaced.
Keep buying
and as a result, these companies have the ability to produce growing dividends and profits even in tough economic conditions.
Absolutely. That sounds exciting. Last time I checked, the world's population was still growing, never mind declining populations in your Japans, in your Germanys, and those other developed markets. But so that's equities. So it looks good internationally. Where do you bring in property? Where would you put property? And in terms of that portfolio construction, what percentage do you give it then?
In terms of property, we see a decent value in international real estate.
Sure.
A developed market.
Again, not at home.
Not at
internationally.
Home. Internationally, you're getting yields in the region of 4 to 5%, which is about on their historic averages of quality companies of the likes of Westfield, the Lincoln in Hong Kong, or RioCan in Canada.
Right.
Locally, however, you've got low yields relative to where they've been historically. You look at a company like Growthpoint, probably the company with the best quality property portfolio in South Africa. Its yield is only 6%.
Right.
Investors
and inflation is 6%.
Yeah, and investors also have to remember that that income stream is fully taxable.
Sure.
So over the long term, we feel that at current valuations, getting a real return from an investment in listed property locally is unlikely over the longer term.
So that's a low percentage in terms of your allocation in your portfolio.
Yeah, we would have maximum exposure to maybe offshore equities and international real estate, but very little, if any, exposure to property locally.
Where do you put bonds then? Where do you put bonds?
Bonds and property are very similar in terms of their valuations and how they behave. Bond yields are also very low in South Africa today. They're below 7%, the 10-year bond yield, which is the lowest yields have been for approximately 40 years. Once again, we feel that's too high a price to pay for that investment, and we would be wary of investing in fixed interest bonds locally today.
We're talking government bonds here.
Government bonds,
Government corporate? We wouldn't touch corporate.
Corporate bonds, you are getting a slight pickup of yield. But in terms of fixed interest bonds, the yields are still low today.
Internationally?
Internationally, like South Africa, the international bond market is also very expensive.
Yeah,
you know, the US 10-year bond today is 2%.
Yeah.
Those yields have been declining for 35 years. So we would avoid international bonds as well.
Absolutely. Interesting you say that, because last year most investors got it wrong. Most of the money was in bonds, fixed income, and then it turned out who was the best performer? It was equities, it was property.
Yeah, I think that investments in quality companies, predominantly offshore, is likely to serve investors best in the years ahead.